business named Angel Advisory. And if you see me, I'm here in the office. Don't judge me. If you can't work from home, don't work from home. Turns out the internet carked it just recently, so I've had to come into the office. But here we are in lockdown. We're talking about super, so thanks for joining us. So we talk about superannuation. Why do people get excited about superannuation? I mean, you all know that if you're an employee, your employer puts money into your superannuation as a superannuation guarantee contribution, which is pretty much that now 10% of your wage that must go into superannuation, and then you can increase the amount you put in. Now, a lot of people, when they start with their super investments, they start with an industry fund, one of these, where people want more control of their investments. They want to invest into shares and things like that themselves. They can move to a retail fund, or when people want ultimate control of their super fund, then they move into a self-managed super fund. Now, self-managed super fund becomes quite a complex area to involve yourself in. It's almost like running another business because you can get quite, tricky with what you invest into within that self-managed super fund, but you've got a lot more control. But there's a lot of rules and regulations when you run a self-managed super fund around what you can and can't do. So it's very important to understand what you can and can't do, and then what your role becomes as a trustee or a director of a corporate trustee when running a super fund. But let's talk a little bit about why an SMSF. So ASIC have released some guidance that you probably shouldn't have a self-managed super fund unless you've got about $500,000 in super or as a combined super fund balance of whoever's joining the fund. Now, recently you've been able to put up to 4 people within a self-managed super fund, so 4 members. And basically, so if you think about it, and I'll give you a perfect example of my family. So I've got my mother and my father. They're a bit older than I am, as well as myself and my brother. We're a pretty close-knit family. We've all combined our super funds together to create a self-managed super fund together. And people say, well, why would you want to do that? Well, we do a lot of things together, but it gives us a lot more purchasing power when you go and buy assets. And what can you do with your super fund? When you do run a self-managed super fund, depending on how you've established your trust deed, you can, what we've spoken about, you can buy into shares, you can buy into properties, you can use Civid to obtain a loan to buy properties. But you can also get a bit more complex. You can buy into businesses, you can buy into private companies. Sometimes, depending on the structure, you can buy into a business that you're even a part of and own shares through that direction. But let's talk about property and borrowing money to buy property. This came about a little while ago, where you could establish a limited recourse borrowing arrangement to buy property, to borrow money to buy property through your super fund. To do this, you have to have a corporate trustee, and you've got to set up this special other bear trust, and it becomes limited recourse in nature because the bank essentially can't come after all of your other assets. Now, over the last few years, there's been a lot of changes that if you are avid property investors, you would have noticed that the property market has been so up and down since 2018 because there's been the APRA changes, there's been the Royal Commission into Banking and Finance. Therefore, a lot of banks have actually pulled the amount of funding they're putting towards borrowing through superannuation to go and buy property. And as a result, you've seen quite high rates. And if Civid's have done a few loans for borrowing money through your super fund to buy a property, rates have been in the way of 5 to 6%, which for a property investor, when you've got a rental return of 2%, it doesn't really seem like a viable investment option. And hopefully you've got the underlying growth of around about 7% a year. Now, if you go off property in Melbourne doubles every 10 years, as it has since 1970, 1960, that's an annual growth rate of around about 7% per year if an asset doubles every 10 years. But obviously, by using debt, you can supercharge the amount you've invested or the value of your cash. But recently, Civid would know that there's been a lot more, we'll say, affordable rates that has come back to the market, which is obviously bringing this strategy back to light for a lot of people. You can buy, what kind of properties can you buy through a super fund? You can buy commercial properties, you can buy residential properties. A lot of the times what people don't realise, though, is there's a lot of hoops you have to jump through in order to ensure you can sustain the loan. You've got to have it set up the right way. You've got to have enough money in there. Now, it's important to remember that when you run a self-managed super fund, it's essentially run as a whole other entity to your personal self. So there's limits on how much money you can put in, the kind of contributions you can make into your fund, and even the kind of property you can invest into and what you can do with that property. Now, you can own a property directly through your self-managed super fund if you've got a larger balance, or if you do use a loan, there's a lot more restrictions. Now, using a loan, you cannot do things like develop the property when you've got it. You can't knock out walls. You can't make a substantial change to the structure or the foundation of the property. This is when you're using borrowed monies. So if you are you can't live there as well. So it has to be for an investment purpose, because it's got to satisfy basically the retirement rules within superannuation to say that, well, I'm buying this asset for the purpose of my retirement, not for my own good use or own free will. One other thing that's probably important to remember when buying a property, if you want to do renovations to the property, you're not allowed to work on it yourself. So you've got to consider it as being a completely separate company, and any expenses that go towards a property must come out of that company. So there's a lot of rules and regulations that come around when you do start to borrow money in order to buy into properties. But obviously, why would people want to buy property through their super fund? The easiest thing to say is that the tax rates within superannuation when they sell the asset, they're the best you can find. For instance, the normal tax rate on earnings in a superannuation fund that's in accumulation phase, so the people that are still contributing, the normal tax rate on earnings is 15%. If you hold an asset for longer than 12 months and sell it, then you'll get a 1/3 discount, so you'll pay a 10% tax rate. But what really attracts a lot of people, and if you're like a lot of my family, when you buy an asset like a property, you want to hold it for a long term, and you really want to take advantage of the long-term capital growth. And why that's beneficial is because when you hit a certain trigger, you can actually turn your superannuation into through their super funds. Now, what's been released recently is you can now have more than 4 people in a self-managed super fund. You can now have 6. It's just important that when you do get involved, and if you do get involved with more people, and you involve people that you're not very close with, it's very hard to unwind it, very hard to get people out, especially when you're all holding one asset, and everyone's got the value of $150,000 in a super fund, and the asset's worth $1 million. Well, how do you get someone out their portion without having to sell the asset? So there's a whole lot of really important considerations that need to come into account and come into play whenever you are trying to pull together money to go off and buy property. Now, I've harped on for a little while and given you all a little bit of background as to superannuation, self-managed super funds, buying properties through super. But rather than have me harp on for too long, I thought I'd give it back to Savid and see if we want to have a bit of a conversation.
Sure. Steph, I think if we can talk about, a little bit more detail about what kind of age we're talking about when it comes to saving on the capital gains side of things, and if there's some particular strategies that people around the 40 to 50 year mark should be looking at in order to use super effectively. I think that'll be a good starting point. And in the meantime, I'll open the floor to everyone to start posting their questions, and then we can start asking them one by one as well.
Yeah, well, so the trigger age at the moment for people that are 50, 58 years old is when they can start turning their super into a transition to retirement income stream. And if they've retired from work, then they may be able to create an account-based pension. And what that account-based pension means is that when they sell an asset, they pay no capital gains tax on it. But really, if you're still working, then the trigger point is normally at around about 65 years old. Where if you sell an asset after the age of 65, and at the moment, if the current value of your personal superannuation is less than $1.7 million, it's the entire value of your super, then when you sell the asset, then generally, if you've done all the right things, then you can essentially get away from paying capital gains tax.
Sure. So we've got a first question. What are the pros and cons of investment in land banking through SMSF?
So land banking, it's really important to understand, are you borrowing money for the asset? What's the purpose towards your retirement? So there's a whole lot of rules before investing in an asset through a self-managed super fund that you have to tick off to ensure it's in the best interest of yourself, as well as you're abiding by all the superannuation rules. Land banking, of course, means you can hold an asset, but whether or not that asset has the capital growth you're looking for, but also you're not really earning any income from a land banking opportunity because no one's renting it from you. Therefore, there's other provisions from the State Revenue Office and things like that you have to consider nowadays when you're not doing anything with the land and the title. So there may be benefits to land banking. Whether or not you can do it is really about getting advice on your personal situation and the kind of type of asset that you're getting. Does it suit your retirement objectives, really, is the main thing to think about.
Sure. Next one is it advisable or possible for an individual to divert super amounts to their SMSF? And whom does it suit, or what's the best case scenario on when to start an SMSF?
So is it advisable to divert money to an SMSF? So it's really important to consider that when you set up an SMSF, you need to ensure you're meeting the diversity requirements. So you need to establish things like an investment strategy for the fund. And within that investment strategy, need to identify what percentage of your funds you're going to allocate to different asset classes, such as direct property. If you're running two super funds, as a self-managed super fund and say a retail fund on the side, then it may become quite complex, and you'll be paying extra fees for both the running and everything like that, the running of both funds. But you can still invest through your self-managed super fund, just like you would through your external fund or industry fund. Now, when it comes to putting money into an SMSF, you've really got to make sure that you're controlling the investments. Therefore, if you're creating an SMSF, diverting your super there, you really need to make sure that it's still growing for your own retirement benefit, and therefore making sure it's invested and living up to the investment strategy. Now, in terms of when's the best case to start an SMSF, ASIC have released a guidance paper that essentially says that if you do not have more than $500,000 as a combined balance in a self-managed super fund, then it's not advisable that you commence a self-managed super fund yourself. People might think of this figure and say, why is that so high? Well, generally that's enough money for people to really start to monitor. There's a big issue in Australia that self-managed super funds have a lot of money in cash, so it's not invested, and therefore it might say that people have actually forgotten about it. Maybe. We don't know. But when's the best case to start an SMSF? Well, when you're someone that really wants to take more control of your investments, when you're contributing larger amounts, and when you really have the time to dedicate to understanding your role as a trustee and your role in running it to ensure you can actually run it properly. The one issue that people have is they set up these SMSFs and they don't understand the compliance requirements in order to run one of their super funds. So it's quite time consuming. So if you don't surround yourself with all the right professionals, then it's going to be quite taxing on yourself to understand it all.
Sure. The next one is, what do you mean when someone says bare trust or corporate trust, and which option is viable for what circumstances?
Well, so when it comes to setting up a trust, any kind of trust, you can either have what's called individual trustees or corporate trustee. So an individual trustee saves a little bit of money from an ASIC fee. Running a corporate trustee is a lot more protection for the individual people. And there's a lot more, I guess, simplicity in running something via a corporate trustee. So when you run a corporate trustee, you're a director of the corporate trustee, still a member within the fund. But the corporate trustee allows, if you need to change the name of any of your holdings or asset holdings, so if you have another trustee that comes into the fund, you don't need to change the name on the title, being the corporate trustee will remain the same. If you had individual trustees, then essentially what would happen here is you'd have to change the name on the title because there's a new person coming in as trustee for your super fund. So the corporate trustee is really who's the controller of the super fund. Where I refer to bare trust, a bare trust is essentially another entity that's set up for the borrowing entity. So whenever you go to borrow money through your super fund, you will have to establish another bare trust as well as the corporate trustee already. So all the legislation around super already says that if you're going to borrow money, you need a corporate trustee for your super fund, but also you need to establish something called a bare trustee or a bare trust. So if you're going to invest into property and use a loan, then you need a bare trust. If not, there's no point setting one up. It's quite important that you actually set up your bare trust before you purchase a property because, different states have different rules, but you need to have the name of the correct trust and company on the contract of sale when you purchase it.
Sure. So, Stefan, going back to the corporate trustee versus individual trustee, is it safe to draw a parallel and say it's very similar to, let's say, if you were to be in the retail space and buying, let's say, property? If it's individuals buying a property and you want to add your brother onto the property, you have to pay the stamp duty to the SRO again, etc., etc. Whereas if it's bought under a company name, you could just add a director to the company, and hence they become an owner of that property as well.
Very similar.
Would that be something similar?
Similar, yeah. There's other tax implications and things like that come into it, and stamp duty regulations. But you could say it's quite similar, yes.
Sure. Okay. Next question. I mean, you partly answered it from the other side, but the question is, and this is something I get asked quite often: what is the minimum amount required to start an SMSF?
Yeah, well, so ASIC have released guidance to say that you need $500,000, no, or you should have $500,000. Do you need $500,000? No. You can also make contributions to your fund. So let's say you've got $200,000 in super, but you've got some personal cash. Then you can make what's called a non-concessional contribution to super up to $330,000, and that could bring your total balance to $530,000. So in terms of amounts, there is no minimum amount, but the accounting and audit fees are higher than just your normal industry fund or retail fund, and therefore they say that at least have a fair bit of money before you go off and start one.
On the topic of fees, that brings us to the next question, which is what is the general setup cost and ongoing cost to manage an SMSF? All
right, so it really differs. You can go to wholesale accountant providers that provide services to professionals like myself, which are a bit cheaper, or you can go to an accountant or a specialist. What we say is that generally for the setup of a super fund with a corporate trustee, you can pay as low as $660, but it can go as high as $1,500. In terms of the running of the fund, it can be as cheap as $1,000, or can be as expensive as $5,000. And if you've got a lot of things happening in there, can go up to 10, especially if you've got a lot of members, a lot of money, and you've got both pension phase and accumulation phase, and you've got different investments as well as loans. So very important to keep track of all that. But the fees that do go into it, when you're setting it up, you need to set up a corporate trustee. You need to set up the trust, which is the self-managed super fund. And then there's some other smaller fees that go into it as well. When it comes to actually running of the fund, the cost to run the corporate trustee this year, it's only $56 because it's a special purpose company that actually doesn't do anything. If you run a business, you know it's quite a lot higher than that for your annual ASIC renewal. But really, you've got the accounting fees, you've got the tax fees, any advisory fees on top of that. And then you've also got your audit fees. So the self-managed super fund needs to be audited each year. And if you, in the future, if you're a bit older, you run both an accumulation account and a pension account, then you're also going to have to pay for an actuarial certificate. And this is where they basically apportion how much money of yours is accumulation, so taxed at 15%, and how much is account-based pension and taxed at 0%. So that's, I don't know if that's a long way to explain it, but yeah, they're the estimated setup costs and ongoing running costs.
Sure. There is a scenario someone's posted. So when debt is paid down, the property must be transferred from the holding trust into SMSF. So do we need to pay stamp duty again? How does it work in Victoria?
This is actually an answer that this is actually something I can't answer directly. So when the trustee changes, do you need to pay stamp duty again? I'd have to come back to that person with the answer on that one. None of my clients have paid down the property in full just yet. We've encountered that situation, so I don't want to come out with making something up. So I'll come back to that person with an answer to that.
Sure. Next one is the property value held in SMSF accounted for the 1.7 million super balance check?
Yes. Yep. So all of your assets in your SMSF, if you've got two people, and then it's a portion, but dependent on what percentage of the SMSF you own, it goes towards the $1.7 million transfer balance cap.
Sure. There's another very specific scenario. So I have an SMSF, me and my wife are members, we're planning to buy our first home, want to contribute additional contribution on top of the mandatory 10% with the objective tasking this amount towards first home super deposit. How can we manage this? If instead of SMSF, I have normal super fund, they always keep separate, but SMSF, how can we handle that?
Okay, so you're using the first home super deposit, so the first home super saver scheme. What I'll do here is I won't give you any specific advice to your personal situation, but I'll just give general information in regards to what are the rules around contributions and things like that. So obviously there's caps on how much you can contribute each year. The cap's just gone from $25,000 to $27,500, which is what you can claim a tax deduction for. In terms of using the first home super deposit scheme, it's really important to read the ATO legislation and the ATO guidance on how to make notifications that you're going to use this deposit scheme, and when to notify the ATO that you're actually going to make the withdrawals. In terms of using the SMSF, if you're saving money to go towards your first home and using your self-managed super fund, instead of just a retail fund, really important just to look at what's your super balance and is it really worth having a self-managed super fund that you're running if you're using the first home super saver scheme. Again, I don't know your personal situation, but maybe it is better just to use your own retail fund. But all the information is on the ATO website in relation to the first home super saver scheme, what to do and when to do it. Again, probably one thing to look into that a lot of people don't think about is there's a certain rule that came about last year, 2 years ago, where you can actually utilize contributions up to the cap that you haven't used in previous years. So it used to be $25,000 was the cap you could use. If you put in $10,000 one year, using the first home super saver scheme. But what I'm going to say